Alicia Garcia-Herrero, who you've already heard, who is the Chief Asia Pacific Economist from NATIXIS. Inwha, who is Executive Vice President and Global Head of Structured Trade Solutions at HSBC. David Koh, who's no relation, although my brother is also called David Koh. Greater China and North Asia Managing Director and Regional Head of Transaction Banking at Standard Chartered Bank. And before the conference, David pointed out that we actually used to work at the same TV station about 30 years ago. But he moved on to a much more lucrative career. Yibo Zhang. Yibo is Head of Data and Analytics at TRADESHIFT, and he was with Alibaba for a long time, so we're going to have a very interesting perspective on data and analytics. William Marshall, who is partner at TIANG Partners, and David Rosa, CEO and founder of NEAT. So can we have a round of applause for our panelists, please? So traditionally, the way this happens is I ask most of the questions and then you get a chance to ask questions at the end. But let me change it around a little bit and let me see if anybody from the audience has any questions. Does anyone want to ask the first question, given what you've heard this morning and given what you think our panelists might be able to tell you? I know I'm putting you on the spot. Yes, okay, Andrew Collier has the first question. Can we get a mic to Andrew? Is there a spare mic?
I mean, I'll just ask it live.
Here it comes. Oh. So everyone.
I was curious about your opinions of whether this expose that Bloomberg has about the microchips that were about spying, is this going to be isolated to a few companies that are doing server software hardware, or is this going to essentially kill the entire tech sector in China for the next year?
Who would you like to answer that first? Who would like to take that on, that first question? Very specific.
Well, okay, so as a trade lawyer, I deal with quite a lot of export control, strategic commodity type matters involving high-tech products. I've also represented some clients, Chinese multinationals involved in some espionage allegations in the United States. Whether or not that has a direct impact on the tech sector in China in and of itself, maybe not. I think there's quite a lot of political headwinds against the Chinese tech sector from the U.S. anyway. Sort of the fight against the Made in China 2025 program, the Section 301 tariffs, which is really all about strategic technologies and the defense of intellectual property rights. And those things I think will have a longer term or a bigger impact on the Chinese tech sector and telecoms in particular.
Maybe just to add to that, so our view is we don't see that of in itself will have a big impact as well. When you think about all the stuff going on in the environment today as it relates to the tech sector in China, it's more around the low tech, as we call it. So it's the phones, it's the maybe kind of low end of semiconductors, etc., which are traded in volumes, and the supply chain is shifting around those, but not necessarily just the microchip sector. We don't see a big impact, at least at this point in time.
Yeah, none of my customers have expressed any serious concern.
Okay. Anyone else from the floor have a question? Yes, over here, there's a gentleman with his hand up. Question over here.
Thank you. Finbar Birmingham, Global Trade Review. I'm wondering, do you guys expect to see more reticence from international banks lending to strategic Chinese projects such as Belt and Road to companies that perhaps are going to be involved in things like Made in China 2025? Will there be more reluctance from international banks to engage on that front?
Okay, I think that's for David anymore.
No, I think instead of Chartered, we're definitely going all in with the Belt and Road. But I think we've always been very selective in the projects we want to support. We're leaning into a lot more sustainability issues. So like last week, we issued a global announcement that we're no longer supporting coal projects on a project financing basis, purely for environmental and climate purposes. So I think, quick answer, no. I think we'll continue to support various things, not necessarily because it's Belt and Road, but because it's a right project and a good project to support in by itself.
So we also have a similar kind of optimistic strategy on BRI. But I would say the following, though. I think the reticence from the overall bank market may not be as robust as Standard Chartered and HSBC, perhaps. So I think at a market level, there is some sentiment around the projects in China, particularly the local projects. So that you're seeing, right? So especially the foreign banks. I think Standard Chartered and HSBC probably are a bit more bullish than the wider foreign bank market. So I think that's, I just want to put that out there. But from my personal view perspective, I think what's going on is the BRI, we don't see it as a China thing only. We see it as a China outbound into rest of Asia and rest of ASEAN, etc. And that's fueling a lot of the growth in the rest of the region. So that's where we see the bullishness of the BRI strategy. It's not China projects of in itself locally, but it's the impact across the supply chain and infrastructure across Asia.
Yeah, David.
Something else to add from the fintech challenger angle, if I may. As you may have heard and read about, the HKMA is about to release some new banking licenses here in Hong Kong, the virtual banking licenses. There have been 29 applications so far, so it's been a very, very hot topic. As part of that, it's been very public that some of the applicants have a very Belt and Road strategy. Some of them are from the mainland, some of them are backed actually by manufacturers of products. So the idea is to go and distribute and finance those products along the Belt and Road. So watch out for these new licenses, which by the way will start coming to market into early next year. So this is something to keep an eye out for.
Okay, I'm going to take the conversation back for a while. So let me just stay with the bankers, because given what we just heard, the pretty negative, use this on mic, the pretty negative gloom and doom outlook, are banks going to cut back at all in financing some of these companies that you can see will be affected by the trade war?
No, I think we've issued numerous statements about how much the trade war will impact Standard Chartered. We can constantly, obviously, keep an eye out. But truth be told, I'm not worried about tariffs. I think companies tend to be more resilient than we give them credit for. Companies struggle more with volatility and various issues. But what would be a major disruptor, and coming back to the topic, supply chain disruptions, I think the biggest potential disruption would be sanctions, which is purely political risk. Like what we saw with the US, what they did with certain Russian companies earlier this year in April. One level of sanctions, then secondary sanctions, it would kill everything. That'd be massive, because so much of our business is done in US dollars across the region. But short of that, tariffs, it's manageable unless you've got really low value added products that just can't compete and multiple substitutes.
Inwha.
So we heard this morning was a bit of doom and gloom. So I think you're hearing from us much more optimistic, kind of glass half full view. So I would kind of, in that tone, as it relates to the impact on the companies as a result of trade war and tariffs, I mean, we see really three sectors, right? Autos, technology, and agri, commodities. That will be the biggest impacted sectors as it relates to the trade war, particularly with US and China. But even so, I think we're definitely not backing out in those sectors. There could be a potential, I think, 50-60 billion impact from an import-export perspective. But we're actually going very bullish on those sectors, because it also presents an opportunity to advise the clients while this is going on and they're shifting operations or what have you. We haven't seen that fundamentally happening yet, but this is all about the future and how do you work with our clients as they mitigate across those three sectors. But we're very bullish on those sectors still, and working with the clients in those sectors more than ever. We have a huge tech focus, huge commodity focus, even more so now than ever. So I would say, that's kind of how we see the world right now. I think as it relates to the disruption on supply chain, trade wars is just one aspect, right? I mean, the way I look at it is there's bigger disruptors. There's bigger disruptors that's going on. The technology, the fast-paced technology, going on across the supply chain that is impacting the way companies do business. That's a huge disruptor that we're working with the clients on. I think the macro factor is one component. And the complexity of supply chain, that's another disruption going on. Because it's not just about US-China or Mexico-US. It's about one material in China going to Mexico, going to US, going to Europe. I mean, it's very complex. So how do you manage that? So that's how we look at disruption, in addition to the trade wars. But specific to your question, those main sectors being impacted were, all in.
Okay. Yeah, Yibo.
So I also completely agree with David that the tariff is like when you build the expectation in, then companies can find a way to solve it. I think the bigger challenge is actually political risk. So that is actually unpredictable and it's a clear cut. But I want to also add that in mainland China, at least, that the supply chain finance has been a very hot topic, and banks and even shadow bankings, all the private funds are trying to go into this market as well. Also, like nowadays, a lot of digitization has been happening in this area. So I think companies are actually finding ways. Banks and insurance companies are also finding ways to make it digitalized so that they can have a clear view of the supply chain and also have a better understanding of what is going on. This new information and data points will actually help the companies to assess risk and lower risk and to bring more money into it. Although facing a bad climate, I think that this is something new that we have to consider as well.
While we're talking about supply chain, maybe both Yibo and William, you can answer this. Are there also opportunities there that can be taken advantage of, and what are they?
I think that, as I mentioned, so for example, like in Alibaba, we actually have a financial product where you can use the Internet of Things to actually track the warehouse, what is going out, what is going in. So we can actually like track what is the actual value in the inventory, and then we can giving out loans or a loan for this company. Like this new information can never done before because we don't have the technology in the past. Like the old method is that a man goes to a warehouse, count the boxes, and then that's it. But now with these new technologies, I think that this is a very good applications for a trade financing scenario. And then I'm sure there are other ways to make it better.
Sorry, my experience is somewhat more old world, I guess. So we're working on quite a lot of supply chain restructuring projects at the moment. So at this moment, I think it's true that the trade war hasn't been a major impact just yet. A lot of purchase orders were issued 6 months ago, 9 months ago, so those orders are still being produced and exported out. But as our clients are, issuing new POs or receiving new POs, they're seeing the volumes dropping off quite substantially. And I think the concern is that, with the tariff rates are sort of eating into the entire profit margin for some of the ICT products that have never been paying any duties before now. And so they're looking at moving manufacturing to places like Thailand in the case of automotive, or Vietnam in the case of sort of the consumer electronics business. That it's a longer term project, and it'll take several months to play out, but that's all sort of in the works at the moment. And I think it's very interesting to see even Chinese companies looking to move their base of operations for manufacturing, at least not the nerve center or the headquarters of the companies, but the manufacturing out of China into sort of Southeast Asia.
Yeah, Alicia.
I'd like to add exactly. I think I fully agree with your view of very, very massive restructuring of the value chain. I think that's going to happen because tariffs are only a trigger to what we had before. Again, I mean, sanctions is all about what, as an economist, I call the stock, what you already have. Yeah. Tariffs is about your flow of FDI. Where are you going to be based? And if you think about what Samsung did in 2008, yeah, as early as that, going to Vietnam. If you think about that early decision to basically move away for reasons that were based on wages in China, if you add that 25%, I mean, that decision makes a difference. If you think about having what I call a direct channel, yeah, I mean, so you have a bilateral trade agreement with the US, which you don't have in China. You may say even Chinese companies actually could come because they have a bilateral trade agreement as well with China and with the Europol. Europol is not ratified. So you find those kind of what I would call islands. Yeah? You could think of Mexico for the US now, which you didn't expect to have only a few months ago. Why do we have it now? Because I think the US is trying to find backyards or islands where to operate and reshore, not necessarily to the US, it would be too expensive, but reshore away from China. So that, and this is kind of to some extent, at least for Mexico, and this is very true for Europe, a regionalization of the value chain. This is what it is. And this means shorter routes, more sustainable, by the way, the maritime routes. It means a lot of things. So the tariffs are only a trigger, and 25% is a good trigger. Let's face it, it's not minor. It's just that we only have 10% so far for the 200 billion. A lot of the 200 billion is low value added, which is mainly, and by the way, some products still exempted. Yeah, if you think about Apple, many of their sourcing chips have been exempted. Why? To give Apple time. But that doesn't mean forever. It means at some point in time they need to see where are we heading. So I think there will be a lot of. That doesn't mean it's bad for the companies, but it means it's a structural change. And I think we'll have basically more regional value chains coming on.
And do you think that most companies are agile enough to realize that this is happening and this is something they need to start preparing for now? I know maybe...
I just want to say really quickly in that one, no. I think a lot of companies have been really hoping and praying that it would go away, or it'll just be negotiated away. I think now everyone is really just starting to realize this. This is the state of affairs now in the world, and a sort of a realigning of regional interests. And I think I've been talking to clients who are just examining and doing feasibility studies with us at the moment. That not taking a decision is taking a decision. So because it takes so long in an electronic supply chain or an automotive supply chain, extremely complex. It's not sewing a shirt or jeans. So not doing something now has an effect 1 year from now. So I think they're waking up as we speak, but it's been a bit slow.
Well, it's just companies are more agile than ever. We've seen, I think Samsung led the way for Vietnam, but you see the continuing surge of investments. I know our branch in Vietnam, we do more business with Korean companies and Taiwanese companies than any other company. They just moved there in such, major force. We see a lot of companies from Japanese companies in Thailand that have moved to India, but that was driven by climate, right? That just, I think some of the monsoons showed how, one thing the infrastructure could have been, and it could be improved, which Thailand did not respond well to. So I think there are a lot of different matters, but I think companies can actually move their supply chains within 2 years, be it auto or heavy. I think the key ones are like if it's highly technical, like an Apple assembly plant, or anything in pharma, healthcare. Apart from that, low engineering, a year, 2 years. So as you've got source of capital, bank support, and workforce.
Inwha, do you see the same thing?
Yeah, I mean, I agree with William. Companies are not agile. There's been a denial factor in the market, right? And now it's going from 200 billion to 260 billion. I mean, so this is becoming real. From our client base, we don't see a lot of shift in operations just yet, except for some of the low tech and some of the commodity players who can do it, you know, in a quicker way from China to Brazil, right? Some of the commodities players, you can do that in a more agile way. But as you go into autos and aerospace, I mean, you just can't do that overnight. So I think that even if you take a decision today, that's going to take about 2 years to even shift the operations. There's a lot of dialogues we're having with our clients around those, and they're contemplating it. But absolutely, you know, it's difficult to do from an agile manner unless you're low tech and you're commodities.
I suppose because you were saying, William, that it's a bit of denial because people believe, okay, this is a Trump-led thing and maybe he won't be there in 2 years. So does it really make sense to move everything and then 2 years later everything reverses?
Yeah, as an American, I'm sorry to say that the fear and trepidation from the U.S. economically towards China is a long trend. It's not unique to Trump, and I think that it's not likely to go away. You know, even if Trump is not reelected. You know, what a lot of people may not know is that the "Made in the USA" sort of economic policy, which Trump's marching down a bit, it was drafted by Paul Ryan, who was Speaker of the House, a Republican, which has at least in the last couple of generations been known as a free trade party. So I don't, in my view. Granted, I'm not an economist, I'm just a trade lawyer, but in my view, I think it's a long problem, and it will go on well beyond Trump.
So it does make sense for companies to be looking at it.
Yeah, I think it does, yeah.
Okay, let's move on to a different topic, liquidity, which of course is the other big theme of today. How do you think these concerns we have about the high debt levels in China will pan out going forward? Maybe, Alicia, can I start with you on that?
So I was writing down your very interesting comments, so I missed the full question, but I think I can still catch up hopefully. Liquidity, yeah? So liquidity, is this an issue? I mean, my point was it's not the main issue because in China, the rest of Asia is very different because China is still insulated. If not, they would not be cutting RRR. Yeah, I mean, it's very insulated, and it will be even more, which means a lot for this city. Yeah, and that's the only way out because China needs to keep that liquidity at home. Now, for the rest of EM, and we had a very interesting presentation by Carlos, which I fully agree with. I think our call at NATIXIS is that we've overdone it in Asia. Meaning, I don't think emerging Asia is as risky as Turkey. I used to be chief economist for EM. Carlos and I worked together on that, and somebody else here in the room. And frankly speaking, I mean, there's no better region, sorry to say, than emerging Asia. Southeast Asia, for a number of reasons, low-hanging fruits, domestic demand, still low urbanization. Brazil is 70% urbanized. Where's the growth going to come from? So I just think that the market is overdoing it because it's pushed by China's very poor stock market performance. But once that, which is our call, we see this liquidity flooding, not going anywhere else though, only China. I think that's going to be quite positive for the whole region because it's so. I'm by the way excluding Pakistan and Sri Lanka for obvious reasons. But if you think about the usual EM Asia play, including India, I think it's going to be better. Yeah.
I think a lot of the countries that were hit in this region that were hit by the Asia financial crisis back in '97 have done a lot to repair their balance sheets, and I think that's somewhat undervalued right now. Here the conversations are going on. And for China, if you think about Stock Connect and Bond Connect and the MSCI index inclusion process that's ongoing, there's so much more liquidity that'll go into China. And I think, again, we talk about all that debt that's piling on into China. The fact of the matter is people are willing to either lend or invest. And actually a lot of that money, a bit like the Japanese economy, actually money from within, investing within. So I think that provides a bit of insulation, and the injection of liquidity through Bond Connect and Stock Connect, I think is not to be underestimated.
Just on the China debt level, I have a slightly different view actually. I think if you look at the China local debt level, it's about, don't quote me on the number, but it's about 200% of the GDP. I think that's an issue. I think it's a systemic issue, actually. So it's not just the debt levels, to your specific question, that's high, but it's a systemic issue. And as we know, China's trying to fix some of that, right? So, they're merging the regulated authorities and trying to be more systemic and rule-based, et cetera. But I think the debt level of it itself is too high. I think there needs to be a correction, whether it's the banks doing more prudent lending locally, not offshore, but locally, or some sort of kind of parameters and metrics that govern that, I think is required, because that's just kind of headed into some sort of crisis, is my personal view.
Okay, but do you see any moves towards any of those corrections?
Yeah, I think the government's trying, right? They've merged the banking authority and the insurance authority. They've given more power to PBOC. Maybe that's good or bad, but there are actions going on, and I think there's genuinely concern in the local government level. They're not going to publicize that, but if your debt is headed towards 3 times GDP,
that's not a good thing.
That's a financial systemic issue.
I just want to say really briefly that they've also restructured the tax administration. So the local tax bureaus have been merged into the state tax bureaus. So the tax receipts are going to go directly up to Beijing and then back down to the local. So there'll be sort of less cash flowing through the system locally that's out of the visibility of Beijing, and I think that will have an impact.
Go back to a couple of the presentations that called out, though, there's a lot of concentration in debt in certain sectors. But as in all sectors, there are winners and there are losers. I think, at some point, the stress is not a bad thing to shake out the losers. I mean, I've seen too many deals where even an equity, it's allegedly the equity injection acquisitions is actually debt funded. So the bank's actually part of the problem, not my bank. We see M&A that's 100% debt funded. And then you remember, this 4 or 5 years ago, right? There was a big buying spree. Companies go out there buying football teams for insane valuations, buying cinema chains for insane valuations. I think a lot of common sense has now come back, whether it's regulated or otherwise. And I think the financial system itself is becoming a lot more disciplined in saying, well, we want to see real equity injection being made a part of this M&A. And the valuations aren't so silly anymore. I think part of that debt, there's, I think your slide talked about overseas acquisitions that have now led to their reliance on overseas markets for revenue. It'll create a different dynamic, which is not necessarily a bad thing. It makes them more exposed. But I think at the end of the day, though, I still believe that the Chinese government, while there's still systemic debt levels at historical highs, they still have a few levers to pull. I think that a lot of lending onshore China is left pocket, right pocket, especially within SOEs, amongst
Right.
SOEs.
Yibo and David, I don't want to leave you out of this conversation. I know you have something to say.
Yeah, I just looked. I've read an article on the internet. It's actually called "The Dust of the Empire," the dust of the empire. But there are some numbers that I want to quote. Is that the government to GDP debt is actually 48%. So it's probably looking okay. But on the private sector, the total is actually 210% to GDP. So it's on the record high. And so to compare, US in 2008, the private sector GDP rate is 170, and then the Japan's one is 220 in 1990, in the 1990s. So it's right on the edge. So I think that yes, it's on a record high and it's very dangerous. But on the other hand, I think that it's been running like this for I think the past 1 or 2 years. And then I think one fact is that China is actually a trade surplus country. And then for that fact, I think it probably will be kind of okay for a while. But it seems that if the crisis happened, then there will be two outcomes according to Ray Dalio's new book. So one is that the forex will kind of okay, and then the house price will dip. The second outcome is that for export dip, and then the house price will also dip. So I think that China is actually kind of okay to maintain the foreign X because it's a surplus country and has a lot of currency. But does it actually willing to because of this trade war? I think it's a good question, and then I think it's worth paying attention to see.
Sure. Yeah. Just another observation. I think along the lines of debt fueled out of M&A, the private equity sector in China is really taking a big dent of late, and this is, I think, very much the result of yet another one of these implementations by the policymakers, which is the shadow banking sector, which has been a major source of this absolute amount of debts, was actually allowed to operate with an asset and liability mismatch. Playing the full role of a bank, right? Taking in 3 months, 1 year time of deposits and lending out for years, right? This has stopped. And this is extremely important because there's no more money printing exercise happening, right? So at least we've had that amount, I think, capped. Now the question is how you're going to be able to contain that, and are going to be able to diminish that amount because there's going to be defaults, or it's going to be a natural progression of less and less lending in the system.
David, I just want to stay with you to talk specifically about SMEs who fall between the cracks sometimes, and the difficulties that they are either going to face, already facing in this environment of tighter liquidity.
Sure. So perhaps let's take a few steps back and look at very much of a grassroots kind of approach. We're in an environment today, let's be honest, where the workforce is really going through a major shift. I've been part of that. Where there's a big move from corporate brand to becoming your own boss, right? Working in much smaller entities, trying, startups, young SMEs, and Hong Kong is actually a really, really interesting place for that because I'm not sure if you're aware, but actually Hong Kong is the second largest market in the world for newly incorporated companies. It is now several years where every year we have 150,000 plus newly incorporated companies. Why? Mostly because of China. Right? It is not only Chinese entrepreneurs, Chinese entities that are setting up offshore, not only from tax point of view, but also to trade with the world, notwithstanding the headwinds that we're facing. But just as importantly, international entrepreneurs that actually want to trade with China with the new, what I call the Made in China 2.0, right? The better quality, the more interesting kind of products being made. However, there's all this supply of new companies. However, the problem is traditional banking institutions find it very difficult to acquire and maintain these customers because the new entities, there is no guarantee that they're actually going to be around next year, right? There is no history of these entities. And therefore there's a huge gap, which is what we focus on, in allowing these entities to basically have as close as possible to a corporate bank account. This is what I mean by grassroots. This is a major impediment overall to the supply chain as well. Big opportunity, and I think Hong Kong is playing a big, big role globally, right, from that point of view, given the strategic position it has.
Yibo, can I get you to comment on that as well?
Sure. I think small business has never not facing difficulties in financing, and I think especially in China, small businesses are very fragile. They can be just making one bad decision and then they can be on the edge of bankruptcy. And we've been seeing like a lot of the export small businesses that like they are just making one step wrong and they have to sell their own house to repay the debt. So especially on this current climate, I think everything is kind of unclear. It's very difficult for them to make the right decisions, and admittedly they need require some luck for them to do that. But I think that but there are on the other side that there are a lot of innovations and also the government support to lend to those small businesses. So for example, 2 years ago there is a tax system reform called gold tax, and then like small business can bankers and the shadow banking system can use the data to help the small business to get the funding they need, because they're now more transparent than before, and people are actually leveraging those data. So I think that, again, I think that there are two sides of the coin. One is that it's a tightened environment. However, the new technology is coming to help.
If I may, I think the liquidity gap, your question is truly for SMEs. I think that persists in all the regions and in Asia in particular. And I think as an industry, we really need to figure out a way to support that. And just to share, I mean, one of the things we're doing, and we work with TRADESHIFT as well, there's two angles, right? SMEs are such an important supplier base for our larger clients. So how do you support them as suppliers, as part of the supply chain? That's one lens we put in. And we have changed the way we do that. Because before, SMEs had the same criteria for a bank than any large company, and therefore you couldn't support them. So we actually came up with a whole new methodology on suppliers. If they're SME suppliers tied to a larger client, we don't do the same assessment, whether it's KYC, whether it's credit. That's one. I think in Hong Kong and China particularly, with the SMEs as local clients and corporates that we work with, we also think, and this is kind of, I think, action to all of us, is if you keep using the same credit metrics that banks and insurers use, you will never be able to support them fully. So we're looking at some performance metrics through transparency of data with the likes of TRADESHIFT and other methodologies to say, what if we came up with a new scorecard and it's not just credit? Because otherwise this liquidity gap, I think, will continue to persist for SMEs. And there's more entrepreneurs than ever, and you have to support them. So we came up with a scorecard in Hong Kong just for very, very small SME companies that's different, and it's all technology-based, and it's different from the usual credit analysis of financials. So I think all of us just kind of need to think for the future how to do that.
Inwha, let me stay with you here. What about the bigger corporates in terms of the risks that we've all heard about this morning? Apart from going to COFAS and buying credit insurance, what else can they do to mitigate those risks and secure more favorable terms?
That's exactly what they need to do.
One more.
We are at a COFAS event. But regardless, I mean, I think we would all say that is risk mitigation is key. With everything we heard this morning, everything the panelists just talked about is how do you mitigate the disruption risk that's going on? And we absolutely use insurance as one of the risk mitigations, and so do a lot of our clients. So we see more and more clients getting interested in that who are not before, is how do you mitigate your political and credit risks smarter than they did before? I think there's a lot of work to be done in this space anyway, as it relates to SMEs. How do you look at the risk differently than before, right? And I'll openly say this, and we talk to insurance companies all the time around how can the insurance as a sector also look at the risk differently and assess it differently. But that's one, so we'll kind of put that to the side, because it is a very important piece, is the business of risk mitigation. The other piece, I think, is how do we help them and advise them, not just the typical lending, traditional lending, but how do you advise them and work with them as they re-engineer and restructure their supply chain? I think that's really the key that we need to work on.
David, what do you view?
Yeah, look, I totally agree. Everything's just been said. We go so far as to look at the terms and conditions of their commercial agreements. But one of the alternative as well, we just syndicated our for a commercial banking client, a smaller client, trade facility. This used to be only for really large customers. Talk about $1 billion trade facility that it's worth syndicating. But now for a $250 million facility, we can also syndicate. I guess the system is just that much more efficient, so it can be done. And we're finding that the investors don't have to always be just other banks. There are other parties in the market that would like to support trade liquidity as well. So that really helps. So we can really, push in the engine to originate and distribute trade risk as well.
Can I just comment on that? But for Asia, I don't know what you guys are all seeing, but we're not seeing as a deep institutional investor base in trade compared to Europe and the Americas, where that's gone very deep. Funds, institutional, family wealth funds have set up pockets for trade assets because of the low default ratio and the self-liquidating and all the good stuff we know about. But in Asia, you don't have that deep liquidity. So if you guys have that, please share with us. But I think that's a very important point you make, because we need non-banks in Asia as an alternative investor base for trade, for SMEs, middle market, etc.
William, what about you in terms of mitigating risks? What are some of the things that people should be doing?
Yeah, so I think that there are several things. I mean, it's been touched upon in a couple of the talks and some of the panelists' comments here that the global value chain is very complex these days, and a lot of it is intangibles, not just sort of the physical manufacture of product. And, in fact, one could argue all day long that the trade deficit's even the wrong measure of the economic activity that's happening. So, in fact, there's a lot that can be done with those intangibles to move functions, to move activities for the company to places that have lower risks, to places that give greater flexibility. And then by doing so, then the company can, if they don't eliminate their exposure to political or trade risks, they at least reduce the financial impact on their bottom line. And so, beyond just, sort of spreading the risk to insurance or to investors in a supply chain finance scheme, the companies themselves can also look at changing the way they operate. And of course there's, foreign direct investment and regulatory barriers there, but I think it's something that's increasingly being looked at by our clients, and it's, increasingly keeping us busy.
Inwha, I like your point about the non-banks. So let's ask the non-banks what your views are and what you feel your role is going to be.
Sure, I mean, I can speak for our role currently, and what I think has got plenty of scope. It's to digitize, to use the word that has been mentioned before, legacy processes. And I think at the heart of every single thing that we do in finance, there is KYC, right? David and I were talking about it before. I mean, we've invested a lot of our resources in developing what is today it's the only fully compliant and fully digital KYC process in town. There's plenty of scope to do this, right? So I think it's not only to offer balance sheet. I totally agree, by the way, that there's a lot of need for extra balance sheet, especially that actually the returns are quite interesting given the absolute level of overall rates and spreads that are actually still low, right? But it's also the technology disruption that the non-banks can bring to the equation to speed up the process, right? To make it a lot more efficient and lean.
Yeah, I completely agree that just one example is that we so I think that the credit assessment it's more like a low frequency trading compared to the stock market. So you are using historical data to try and macro data to predict which one is stock is going to rise, and the data is a little bit lagged, and then it's always coming from corporate survey, and there's a time lag. But if we can digitize the entire supply chain network, then it's a little bit more like a high frequency trading, that you have every trade coming in, you will have more information than ever to help you to assess the company's health. And then you don't have to actually assess the entire company's health. You can access that specific trade because you have more information. So by changing that idea, I think that it will help to for the financial companies to giving out loans and to actually have an entire new perspective of evaluating loans.
Okay, I'm afraid we're out of time, but I do want to thank our panelists for this really interesting discussion, which we did cover a lot of different topics. So please give a round of applause to our panelists. Thank you, David, William, Alicia, David, and Inwha. Thank you so much. And you may go back to your seats now. Thank you so much for spending the time up here with us.